Welcome back to the Deep Dive. Today we're dissecting a truly remarkable shift in corporate finance, one that's been, well, unfolding at an astonishing pace. Get this. Between December of 2024 and just June of 2025, the number of publicly traded companies holding Bitcoin in their corporate treasuries didn't just grow incrementally. It practically doubled.
Yeah, that jump was pretty stark.
It really was. We saw a jump from, 70 companies to a staggering 134. And collectively, they've accumulated a formidable 244,991 BTC. Now, that's not just a statistic, right? It feels like a clear signal that something profound is happening as these, traditional businesses venture into what many consider the new frontier of Web3.
Definitely. It's moved beyond just the usual suspects, the tech-forward firms.
Exactly. So this rapid surge, it immediately brings us to a huge question, really the heart of our deep dive today. Are these corporate crypto moves a strategic masterstroke? Maybe a brilliant lifeline for struggling firms looking for innovation, new value? Or are they, as some are ominously warning, a ticking time bomb, something leading to what they call a death spiral?
That's the million-dollar question, isn't it? Or maybe the $250,000 Bitcoin question.
Right. So we're going to peel back the layers today, look at the different perspectives, the inherent risks, and what this all truly means for anyone navigating this fascinating, sometimes, let's be honest, turbulent intersection of traditional finance and Web3 technologies.
Yeah, it's a complex landscape, no doubt.
And we're here to help you make sense of it.
It's increasingly clear that we're living through an era of really accelerating digital asset adoption. So understanding the fundamental motivations, the why behind these moves, and crucially, the potential long-term consequences. It's not just academic anymore.
Right.
It's absolutely crucial for anyone involved in finance or technology today. So our mission for this deep dive really is to dig into a stack of recent articles, research you've shared, and extract the most important nuggets of knowledge. We want to help you move beyond just the headlines and truly navigate this complex, fast-moving space with hopefully some clarity.
Discern the signal from the noise, basically.
Yeah. Exactly. And understand not just what's happening, but why it actually matters.
And that's precisely why you should care. Whether you're an investor trying to make sense of company financials in this shifting market, or maybe you're an industry observer keen on spotting the next big disruption, or maybe you're simply curious about how crypto is reshaping corporate strategy across the board. This deep dive is for you. We really aim to equip you with the tools to critically evaluate these moves, to look beyond the surface buzz and understand the deep strategic implications at play.
Sounds good. Let's dive in.
So let's jump right into the data. Okay, those numbers we just kicked off with, they really are significant, aren't they?
They really are.
That jumped from 70 to 134 public companies in just 6 months, accumulating nearly 250,000 Bitcoin. It's way more than just an isolated blip. It feels like a clear, undeniable sign that corporate crypto holdings are solidifying their position as a significant market shift.
Yeah, it's not just the early adopters anymore, like you said. It suggests a much broader embrace is happening, and at a pace that, frankly, demands our full attention. But, this rapid accumulation of crypto by corporations, particularly Bitcoin, it presents a truly nuanced picture when you start looking beneath the surface.
How so?
Well, it's rarely a simple case of every company suddenly having this deep, unwavering belief in the long-term vision of DeFi or acting solely as a pure, conviction-based investor. In fact, many analysts are raising some serious red flags here. They're warning that some struggling firms might be acquiring these crypto reserves primarily to, quote, project strength.
Okay. So like putting on a brave face.
Exactly. Or even maybe to influence short-term market sentiment. It can be a very dangerous game. Think of it as a calculated move to arbitrage market sentiment, where firms maybe exploit a perception gap between traditional valuation metrics and the, let's face it, often speculative appeal of crypto.
So they're trying to buy confidence.
In a way, yes. Trying to buy investor confidence with a volatile, often misunderstood asset. And this strategy, it might offer a temporary boost, sure, but it often only works until the broader market narrative shifts, or maybe a downturn exposes the lack of underlying fundamentals.
We've seen this movie before, haven't we? Like the dot-com era.
Absolutely. Companies adding .com to their names just to seem innovative, sometimes with no real internet business behind it. The immediate goal here, often, seems to be short-term optics taking precedence over a genuine, well-thought-out, long-term strategic integration of digital assets.
So it really becomes less about a fundamental belief in the tech or the asset's utility, and much more about perception management. Is that the idea? A kind of strategic PR play.
Precisely. I think that's a good way to put it. It's a prime example of a PR play. Companies might be trying to appear innovative, signal their forward thinking, or perhaps just trying to ride a prevailing market narrative. You see insights from sources like CoinLive, discussions on platforms like Reddit. They consistently point towards this. There's this palpable pressure sometimes, you know? Companies might feel they have to keep up with competitors.
Especially if a rival announces a crypto treasury and their stock pops.
Exactly. That can trigger copycat moves, sometimes without the proper due diligence, maybe lacking a deep understanding of the risks involved, or even without a clear, fundamentally sound business reason for doing it in the first place. It's a strategic decision that, if it's not really grounded in strong business fundamentals, can introduce an alarming level of risk to the company's balance sheet and its long-term survival chances.
That is a crucial distinction, isn't it? It really makes you wonder, if you were meticulously reviewing a company's balance sheet, and you saw a significant chunk allocated to Bitcoin or something similar, would your first reaction be trust?
Enthusiasm.
Or would that instead make you want to dig much, much deeper into their real strategy, their core business health, their long-term vision?
Yeah.
It's not just what they hold, but the really important question of why they hold it.
Yeah.
And that leads us directly, I think, to what some are calling the potentially darker side of this whole trend. While the enthusiasm for crypto adoption in corporate treasuries is, definitely palpable.
Yeah, you see it everywhere.
Right. But there are these grave warnings being sounded about what's ominously termed the death spiral. It sounds dramatic, I know, but the mechanics behind it are incredibly sobering. The risks seem very real.
Yeah, this truly raises a big question about the sustainability of some of these strategies. A recent VC report actually detailed this death spiral model, and it's a mechanism we absolutely need to break down step by step, just for clarity.
Okay, let's do it.
All right, imagine the scenario. The price of Bitcoin drops significantly. Okay. Companies that are heavily exposed to that BTC risk, they suddenly see their net asset value, their NAV.
Which is basically assets minus liabilities, right?
Right.
A true health indicator.
Exactly. Their NAV rapidly erodes. And this isn't just like a paper loss. It directly impacts their balance sheet strength, their ability to get new loans, and it can send a really chilling signal to investors, to creditors.
Okay, so NAV drops. What happens next?
Well, this erosion, particularly for firms that have maybe leveraged their holdings or use them as collateral for loans, it can trigger margin calls.
Ah, the dreaded margin call.
Right. These are urgent demands from lenders or even potentially DeFi protocols for more collateral to cover those potential losses because the value of the initial collateral has fallen.
So they need to pony up more cash or assets fast.
Precisely. And when faced with these margin calls, companies are often forced, absolutely compelled, to sell off their crypto assets, sometimes at really unfavorable prices, just to meet their obligations and avoid outright default.
Okay, I see where this is going.
And here's where it gets really interesting, or worrying, depending on your perspective. This is where the spiral accelerates. Those forced sales, often pretty substantial in volume, they in turn create further downward price pressure on Bitcoin in the broader market.
Making the price drop even more.
Exactly. And as the asset price drops further, the value of the remaining treasury falls even more, which can then trigger
more margin calls.
More margin calls leading to more forced selling. It becomes this vicious, self-reinforcing downward cycle, a cascade where each step just intensifies the next one. The report's conclusion was stark, really uncompromising. Only well-capitalized, disciplined firms may survive.
Wow.
Yeah. It really underscores that this is not a strategy for the faint of heart, and that not all crypto treasury strategies are created equal, regardless of the initial market excitement. We've seen sources like Reddit, Cointelegraph, Chaincatcher all highlighting this critical vulnerability.
So if we try to visualize this price versus NAV spiral model, like a verbal flow chart, it's a chain reaction, right? You start with a falling BTC price. Arrow points to erosion of net asset value, weakens the company.
Right.
Arrow points to margin calls. Lenders demand more collateral.
Yep.
Arrow points to panic forced sales. Selling crypto at bad prices.
Often the worst time.
And that arrow points right back to Tana, further drop in BTC price.
Yeah.
And the loop just keeps going, getting worse each time.
That's the terrifying logic of it, a self-perpetuating cycle. And, to truly understand a company's vulnerability to this potential spiral, we really need to dig into its comparative credit structure. This is a critical differentiator for survivability.
Okay, what do you mean by that?
Well, we can basically categorize companies based on how they funded their crypto purchases. Did they primarily rely on equity, meaning, their own cash or
Yeah.
shareholder funds, or did they use debt?
Ah, okay. Borrowing to buy crypto.
Exactly. And companies that have debt-backed crypto treasuries are far, far more susceptible to these margin calls and the whole death spiral scenario during market downturns.
Makes sense. More pressure points.
Absolutely. It highlights the critical importance of having a strong liquid balance sheet. If your crypto holdings are leveraged, meaning you've borrowed against them, your risk profile fundamentally changes. You become exponentially more vulnerable to market volatility. The difference between having a cash-funded treasury versus a debt-funded one, it can literally be the difference between weathering a severe market storm and spiraling into insolvency. These debt-backed positions often come with strict covenants, liquidation thresholds. They're just unforgiving in a bear market.
Okay, so while Bitcoin definitely dominates these headlines, and understandably so, given its market cap and the attention it gets,
It's the big one.
it is, but it's important to acknowledge the conversation isn't only about BTC. The motivations behind corporate crypto adoption also stretch to other assets, like Ether, for instance. And they dip into these other realms we touched on: PR, activist investor influence.
That's a really crucial broadening of the scope, and what's particularly insightful here is Ethereum co-founder Vitalik Buterin's take on Ether, or ETH treasuries. It's actually quite balanced.
Oh, what does he say?
Well, he actually endorses public Ether treasury firms. He sees their role in expanding access to the broader Ethereum ecosystem as, a positive development, fostering decentralization, innovation.
Okay, so he sees the potential upside.
He does, however, and this is the critical caveat, he strongly cautions against over-leverage. He explicitly warns that, quote, reckless strategies could spiral into systemic failures.
Systemic failures. That sounds serious.
It does, and it's a key point because ETH, with its staking capabilities, its integral role in DeFi, it offers different yield-generating opportunities compared to Bitcoin.
Right, you can stake ETH, use it in DeFi protocol.
Exactly. Companies can stake their ETH to earn rewards for helping secure the network, participate in various DeFi protocols, but with those different opportunities come different, often more complex risks.
Such as?
Well, over-leveraging ETH holdings, especially within DeFi, could expose a company to specific vulnerabilities like smart contract risks.
Meaning bugs in the code.
Right. Potential bugs or exploits in the underlying code managing the ETH, which could just lead to asset loss, poof. Then there's impermanent loss, this temporary value divergence liquidity providers face on decentralized exchanges, which can become permanent if the market moves against you.
Okay.
And of course, liquidation risks remain, perhaps even more pronounced if assets are used as collateral in highly volatile DeFi lending protocols.
So more ways to potentially make money, but also more ways to lose it.
Precisely. The potential for yield generation is definitely there with ETH, but it demands far greater discipline and a much deeper understanding of these unique inherent risks compared to just, say, holding Bitcoin in cold storage as a store of value. And Buterin's warning about systemic failures, that implies that a widespread adoption of reckless ETH treasury strategies could potentially create a domino effect across the broader crypto market, not just hurting individual firms.
Okay, so if we compare the, let's call them ETH versus BTC treasury risk profiles, we're looking at fundamentally different risk-reward propositions, aren't we?
Absolutely distinct.
Bitcoin is often pitched as that digital store of value, the long-term inflation hedge, kind of like digital gold in the treasury.
That's the common narrative.
ETH treasuries, though, might be playing a more active game, seeking yield through staking or DeFi, but balancing that against higher volatility, more complex smart contract risks, liquidity issues.
That's the trade-off, exactly. Potentially higher returns from active management, sure, but also potentially higher exposure to the unique complexities and vulnerabilities of the DeFi world, which can be significantly different from just holding BTC in a digital vault.
Got it.
And this brings us to another really fascinating, maybe even more cynical aspect of corporate crypto adoption, the whole perception game.
Ah, yes, the PR angle again.
Right. There's this growing trend of PR, activism, and copycat moves driving these decisions, often overshadowing any genuine strategic or technological integration. It's not always about the CEO having some deep conviction in Web3 anymore.
So what's driving it then?
Well, if we connect this to the broader world of corporate governance, you now have activist investors actively urging struggling companies. Think about all the buzz around GameStop, for example, to adopt Bitcoin Treasuries.
Really? Why?
Their explicit goal isn't necessarily about the company's core business getting fundamentally stronger or more profitable. Instead, it's primarily about boosting investor sentiment and hopefully the company's stock performance.
Wow. So it's purely about manipulating the stock price.
It looks that way in some cases. It represents a pretty profound shift in corporate strategy, or at least tactics. It illustrates this growing trend where crypto assets are being used more to shape market perception, generate buzz, rather than reflecting genuine improvements in the core business fundamentals.
So signaling something to the market, whether it's true or not.
Pretty much. Whether the underlying business has truly changed or become more profitable is almost secondary in these cases. Sources like the New York Post, Cointelegraph, they've highlighted how this is becoming a powerful tool in the activist investor's playbook. It's about attracting maybe a new type of investor, generating media attention, possibly riding a wave of speculation and FOMO, that fear of missing out, simply by getting associated with the crypto space. It's really a psychological play on market participants, leveraging the narrative power of digital assets.
That's a truly powerful and, yeah, somewhat unsettling point. It really begs the question for you, our listener.
Yeah.
If your company was struggling, facing serious challenges in its core market, would adding a big chunk of crypto to its balance sheet genuinely help it in the long run? Would it really fix the fundamental business problems? Or, and this is the critical counterpoint, could it ironically make things even worse? Especially when the market inevitably turns, those volatile assets lose value, and it further erodes an already fragile position.
It's a huge gamble.
Yeah. It's about discerning whether such a move is a genuine solution or just a temporary, very high-stakes Band-Aid. Okay, now let's move from these theories, the models, the strategic thinking, to some concrete stories. Because these real-world examples, they really help bring these abstract concepts to life. They offer some stark cautionary tales, illustrate these races for market share, and even give us glimpses of genuine strategic pivots.
Yeah, the case studies are where the rubber really meets the road.
Definitely. So our first case study is a truly stark cautionary tale. It really illustrates that death spiral in action. Windtree Therapeutics and their BNB Treasury.
Oh, I remember this one. Not pretty.
No. Windtree, a small biotech company, was already struggling financially. Their core business, developing therapies for lung diseases, hadn't delivered the breakthroughs needed for, sustained profitability. Yeah. So in what seemed like an attempt to inject new life, new excitement, they announced a significant acquisition of Binance Coin, BNB, for their treasury.
A bit out of left field for a biotech.
Right. And following this news, their shares did see a brief, pretty enthusiastic spike, probably fueled by speculative investors hoping for some kind of crypto-driven turnaround. But that excitement was tragically short-lived. Within weeks, their stock collapsed by a staggering 90%. Ultimately, they faced delisting from major exchanges. Just gone.
And what's truly illuminating here, or perhaps sobering, is that Windtree Therapeutics serves as almost a textbook example of the death spiral we talked about.
How so?
It just showcases how quickly a speculative crypto play can completely unravel if it's not backed by robust fundamental business health and a clear, sustainable revenue model. The BNB acquisition, instead of being some strategic asset, it clearly became a liability when the crypto market inevitably turned downward. Their already precarious financial position was just massively exacerbated as the value of their treasury plummeted. That likely triggered margin calls or maybe just a complete loss of investor confidence. The sources we saw from Cointelegraph, TradingView, A-Invest, they paint a very clear, very tragic picture of this rapid downfall.
So it wasn't a question of if it would go wrong, but when.
Pretty much. It highlights the extreme danger of using crypto as a desperate last resort, like a Hail Mary pass, rather than a carefully integrated part of a sound, disciplined financial strategy. This company was essentially trying to outrun its fundamental problems with market sentiment, and it failed spectacularly.
Okay, so that's the cautionary tale. Then we have a different kind of market dynamic playing out. You see this with companies like Metaplanet, which is a Japanese financial services firm, and Semler Scientific, a U.S. medical device company.
Right. Two very different core businesses.
Exactly. And these public companies seem to be engaged in a kind of race to become major BTC holders. They're vying for market attention, signaling their embrace of digital assets, and perhaps hoping to ride the next big wave of price appreciation.
Yeah, it feels a bit like keeping up with the Joneses crypto edition.
Ah, maybe. So how should we think about this race?
Well, if we connect this back to corporate strategy, analysts are generally quite cautious about this kind of race. They warn that these strategies often lack sustainability if not grounded in core business strategy.
Meaning.
Meaning, while accumulating Bitcoin might initially attract a certain segment of crypto-native investors and generate some positive media buzz, it doesn't fundamentally alter the company's ability to generate revenue or profit from its actual core products or services. For Metaplanet and Semler, their primary business models are not inherently tied to Bitcoin's performance.
Right.
One's in finance, one's in medical devices. So this doesn't necessarily look like innovation or leveraging blockchain tech for operational efficiency. Instead, it appears to be primarily about accumulating assets purely in the hopes of significant price appreciation. The Financial Times, Cointelegraph, they highlight this distinction. They remind us that asset accumulation alone, especially of volatile assets like Bitcoin, doesn't guarantee a sustainable future. It's largely a speculative bet. It's a treasury policy change that acts more like a hedge fund strategy than a strategic business pivot. And that makes their long-term viability highly sensitive to crypto market cycles.
Okay, so speculative accumulation. But there's also a powerful counter-narrative out there, right? A story of genuine strategic pivot, of transformation. Let's look at Core Scientific.
Yeah.
They were a major Bitcoin miner.
Huge player in the mining space.
Right. And they sidestepped the growing crypto fatigue, the inherent volatility of their mining business, by dramatically transforming their operations. How do they do that?
Well, instead of solely relying on Bitcoin mining, which, as you know, is super capital intensive, subject to extreme price swings, energy cost fluctuations, they pivoted strongly towards AI cloud services.
Leveraging their infrastructure.
Exactly. And this strategic shift, it didn't just land them a massive $3.5 billion contract. It truly revived investor flair and put them on a new, seemingly more sustainable growth path. What's truly fascinating here is that Core Scientific's case offers such a powerful counter-narrative to the purely speculative plays we just discussed.
How so?
Well, they clearly recognize the inherent limitations and the volatility of being solely dependent on Bitcoin mining, especially during periods of crypto fatigue or those brutal bear markets. So instead of just doubling down on mining or maybe making a desperate leveraged crypto treasury move like Windtree, they adapted their core business model. They leveraged their existing infrastructure, those massive data centers, the cooling systems, their significant power capacity, and they repurposed it.
For AI?
For the burgeoning demand in high-performance computing that's required for AI cloud services. This wasn't about buying Bitcoin to boost sentiment. This was about building a new, robust, diversified business line.
And that $3.5 billion contract.
It's a huge testament to the market's reception of that pivot. It shows a company finding new, sustainable revenue streams rather than just relying on crypto asset appreciation lottery tickets. This strategic pivot, it really underscores the immense value of genuine innovation, operational adaptation, diversification over mere asset holding. It really raises an important question for other companies in the space. Can they evolve? Like Core Scientific, can they truly innovate and build new businesses rather than just accumulating volatile assets and hoping for the best?
Yeah, these varied examples truly drive home how critical it is for you, as an informed observer, maybe a potential investor, to evaluate each company's strategy with a really fine-tooth comb. It's just not enough anymore to see Bitcoin on the balance sheet and assume it's automatically a good thing or even a bad thing necessarily. The context, the why, the motivation, the underlying business fundamentals, they are everything.
So we've walked through quite a bit today. The surging trend of corporate crypto treasuries, the perilous death spiral risks, the really varied and complex motivations from genuine strategy sometimes to PR stunts, activist plays.
The whole spectrum.
Right. And we've gleaned critical lessons from these real-world examples, from the unfortunate collapse of Windtree to the strategic race by firms like Metaplanet and Semler, and finally, that powerful counter-narrative of Core Scientific's pivot to AI. Now, let's bring it all home. Let's discuss why this truly matters for you and how you can maybe develop a robust framework for evaluating companies in this really dynamic landscape. Yeah, this really raises that crucial question investors and analysts have to ask themselves. Are companies genuinely adopting crypto for long-term strategic benefits? Or are they just chasing headlines, looking for that short-term market pump? And to truly distinguish between those two, investors really need to meticulously evaluate several key criteria, going way beyond just the superficial
Okay,
announcements.
so what should they be looking for?
First, I'd say scrutinize their treasury discipline. How rigorously are these digital assets actually being managed? You should look for evidence of clear, publicly communicated strategies for how they acquire them, what their holding policy is. Also, robust custody solutions are key. Are they using cold storage? Multi-signature wallets to minimize hacking risks? Is there transparent reporting of their holdings and any associated risks?
Like, are there established risk management policies, maybe a dedicated committee overseeing this stuff?
Exactly. A red flag might be a sudden, large, unexplained crypto acquisition without any clear governance around it, or just a general lack of transparency in their reporting. That feels impulsive, not strategic.
Okay, so Treasury discipline first. What's next?
Second, and this is critical, investigate their debt exposure. How much of their crypto holdings are leveraged? This is perhaps the single most important indicator of risk, as we discussed. It directly influences their susceptibility to that death spiral.
So how do you find that out?
Investors need to meticulously examine financial statements, especially the footnotes, look at proxy filings for any specific loan agreements where crypto assets might be used as collateral, understand the terms, know the liquidation thresholds, any covenants tied to these loans. A high degree of leverage just significantly increases their vulnerability to market downturns. A company with, say, 70% of its Bitcoin treasury backed by a loan that has a 20% margin call threshold. That company is in a far more precarious position than one holding Bitcoin solely with equity, especially if the market takes a sudden, sharp dive.
Right, much less wiggle room. Okay, discipline, debt exposure. What's the third piece?
Finally, and maybe most importantly, analyze management's real strategy. What are the fundamental underlying reasons for holding crypto, beyond just hoping the price goes up or getting a nice PR hit?
Is it genuinely integrated into their core business model?
That's the key question. Are they using crypto for, say, more efficient international payments? Are they developing new Web3 product offerings that actually leverage blockchain technology? Or is it perhaps a measured hedge against inflation for their core operational capital?
Give me an example.
Okay. Is a gaming company actually building NFT integrations that directly generate revenue? Or is a software company maybe using blockchain for supply chain transparency for its clients? These are concrete examples of strategic integration. A deep dive into these factors is absolutely essential to distinguish between companies that are genuinely building for a sustainable future within this evolving Web3 ecosystem and those that are just making risky, maybe even desperate plays that could unravel really fast. Knowledge here isn't just power, it's protection against potential financial pitfalls.
Absolutely. We're really talking about the crucial difference between genuine innovation and just, well, financial window dressing. It's about applying a healthy dose of skepticism and doing your homework, conducting thorough independent research. So for you, our listener, out there making sense of all this, when you look at companies adopting crypto treasuries, do you see compelling evidence that these moves are demonstrably strengthening their core business, creating sustainable long-term value? Or do they mostly seem like flashy headlines that just quickly fade when market sentiment inevitably shifts, maybe leaving the company in an even more precarious position than before? It's a question that gets right to the heart of what real corporate strength looks like in this new, rapidly evolving paradigm.
Okay, we've covered a lot of ground today on the deep dive. We started with that exciting, almost bewildering growth of corporate crypto treasuries.
The surge was real. It was. Then we delved into the serious risks, particularly that ominous death spiral, and the crucial role leverage plays in accelerating it. We explored the nuanced, often mixed motivations behind these corporate decisions, everything from genuine belief to PR stunts and activist plays.
A complex mix.
And we learned critical lessons from those real-world examples, the cautionary tale of Wintry, the race for holdings by Metaplanet and Semler, and that powerful counter-narrative from Core Scientific Strategic Pivot. This space is undeniably dynamic, it's complex, and it requires incredibly careful, multifaceted consideration from really every angle.
Yeah, our discussion today really reinforces the idea that knowledge is most valuable when it's not just accumulated, right? But when it's truly understood and consciously applied. It really encourages critical thinking and demands a nuanced perspective when you're confronted with new information and these rapidly evolving market trends. There's always more to learn in this space, always. And embracing multiple perspectives, rather than just falling into a single narrative trap, will always enrich your understanding and equip you to make more informed decisions. That's really the core, I think, of navigating this new frontier effectively and responsibly.
Absolutely well said. And just before we get to our final thought, a quick note. If this deep dive helped you cut through some of the noise around the crypto treasury narrative, maybe helped you better identify the players that truly matter, please consider subscribing to the channel, maybe leaving a comment below, and engaging with our content. Your support, honestly, it truly helps us boost visibility in the algorithm, and it really powers our mission to keep bringing you clear, timely, and insightful Web3 analysis like this. We really appreciate it.
Definitely helps keep the lights on.
It does. Okay, so as we close this deep dive, here's a thought for you to ponder long after our voices fade. In a world where perception can seemingly be bought with just a balance sheet entry, what truly defines a company's strength? And, maybe more importantly, how will you distinguish sustainable innovation from just another fleeting headline? Thanks for joining us on the Deep Dive. We'll see you next time.